In the past few weeks, the biggest banking collapse crisis since the 2008 financial crisis unfolded before our very eyes.
Silicon Valley Bank collapse?
Collapse of a big bank.
Two big bank failures are roiling the financial market.
Funds, depositors, and companies scrambled to recover their deposits, while banks struggled and ultimately failed to stem their bleeding losses. Even now, markets remain on the edge. In fact, many are of the mind that the crisis is far from over.
More trouble is coming.
What exactly happened? How did it happen? What part does crypto play in this? And though we're not quite as charming as Margot Robbie in a bubble bath, watch on and together we'll get to the bottom of things in this video. On March 8th, Silvergate Bank, a major banker to the industry, shut down its operations and began liquidation following the bankruptcy of FTX. But this was only the very tip of the iceberg. The biggest banking crisis since Washington Mutual in 2008 traces back to this bank called Silicon Valley Bank. Silicon Valley Bank, as its name might suggest, has a niche clientele that mainly consists of startups, venture capitalists, and many smaller tech companies. The pandemic in 2020 was a hot market for all these clients, and deposits from these clients started soaring. With this sudden large influx of cash, SVB decided to invest in the US Treasuries and government-backed mortgage securities, just as most banks would. It was the best of times, it was the worst of times. Soon after the pandemic wave passed, inflation started rearing its head towards the fast-growing economy. This was when the Fed started their firefight against inflation with a series of rate hikes. Given the rising rates, depositors started pulling out funds from banks in search of greener pastures in money market funds, which now offered higher rates compared to what the banks were giving.
Money market funds, they were among the big recipients.
This impacted smaller banks like SVB, as they simply could not afford to match and raise their deposit rates, as the interest rates on their US Treasury bonds and mortgage-backed securities bonds were bought from when interest rates were at record lows. This meant that their assets were now earning them less than the current Fed rate, and, well, the banks couldn't pay more than what they were earning. It certainly didn't help that cash-strapped startups and tech firms started hungering for liquidity too. Soon, inflows turned into outflows for SVB as its clients swarmed to withdraw. Remember, when interest rates rise, bond prices fall. The wheels for SVB finally came off when they were forced to sell their bonds to pay their depositors, taking on a multi-billion-dollar loss. The bank tried to raise additional capital by selling its shares, but this was the straw that broke the camel's back, sparking a frenzied bank run that dried up its cash reserves. This forced the government to step in and provide liquidity just to make the depositors whole. Over the same weekend, the FDIC had to shut down Signature Bank, when it too suffered a run when depositors rushed to withdraw after getting spooked by the collapse of SVB. Shortly after, long-standing megabank Credit Suisse graced the headlines too, for all the wrong reasons. Mired in controversies, the sell-off for Credit Suisse shares already started all the way back in 2021. But when its share prices dipped by 30% in March, Swiss authorities had to step in, but even then, this was not enough. In the end, the bank's biggest rival, UBS, swooped in with an emergency takeover. Meanwhile, in the US, First Republic Bank was also on the brink of collapse. Remember Silicon Valley Bank? As it turns out, Circle, the issuer of USDC stablecoin, was also one of their clients. When Circle announced that they had $3.3 billion worth of their cash reserves held at SVB, panic ensued in the crypto valley. Following this, USDC depegged and plunged to 87 cents, while other dollar-pegged stablecoins such as DAI, USDD, and USDP also followed suit. Since then, they have all recovered their dollar peg. Somewhat ironically, Circle wasn't the only crypto company falling victim to the troubles brewing in the world of traditional finance. BlockFi, Avalanche, Proof, and Yuga Labs also revealed their exposure to SVB. But here comes the tough question. Is crypto the villain or victim in this arc. While Senator Elizabeth Warren is quick to pin the blame on crypto for the collapse of crypto banks like Silvergate,
Elizabeth Warren wants Silvergate Bank to explain its ties to FTX.
there's actually a broader, perhaps more concerning systemic risk at play here. Just as President Biden put it, no, it's not over yet. The same underlying issues that plagued SVB, Silvergate, Signature Bank & Co. are also in other banks, which means they too will be vulnerable to bank runs, especially since pretty much all banks run on a fractional reserve system, and paired with the fact that nowadays money is digital and can essentially move at the speed of light. It's not like in the old days where people would need to physically show up at their bank and fill out paperwork. A recent study shows that US banks are carrying an unrealized $620 billion in total losses due to the value drop in their government bond portfolios. Thanks to creative legal accounting tricks, the banks have been able to hide these massive unrealized losses from their depositors and shareholders. Another study shows that if even just 10% of uninsured depositors withdraw their money from banks, 66 banks would go under. And if 30% of these depositors withdrew, 106 banks would fail. By this logic, banks as they are simply hanging by a thread that is consumer confidence. And if that ever snapped... As for crypto, Warren is hell-bent on continuing her onslaught against the industry.
Am I buying euros? Or am I
Are you buying air?
Going as far as building an anti-crypto army that earned applause from even the conservatives. The age-old battle against regulation continues for Web3, and this time around, the arena may turn out to be crypto-friendly banks. As things look, the ride ahead is still bumpy, and as always, we caution our users to stay safe and always DYOR. If you want to learn how to properly DYOR, check out our previous video right here.